Cisco surpasses Microsoft as world's most valuable company. This was published 24 years ago, April 2nd, 2000. Internet equipment maker Cisco Systems Incorporated has pushed past Microsoft Corp to become the world's most valuable company, furthering highlighting the web's growing influence on the economy. Well, as you will see on the screen, you know what happened next. Why am I showing you this? Well, Nvidia reached a value of $3.3 trillion on Tuesday as share rose around 3.3%, moving past Microsoft and Apple to become the highest valued company in the world. The company became worth the combined market cap of two other mega cap names, Amazon and Tesla, in May. And so, you've probably already seen all the memes, all the posts. Nvidia is in a Cisco, Nvidia will crash, this and that. So let's discuss that. Nvidia is now the largest company by market cap on this planet. Let's discuss, let's compare it to Microsoft and Apple, valuation-wise, and how much money they're generating, profits, free cash flow, you name it. Before jumping into that, of course, share your predictions down in the comment section below. Who will be number 1, number 2, number 3 by the end of this year? Also, hit all the buttons, like, subscribe, notification bell, do all of that. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. I do first want to touch on the AI bubble aspect. For that, we have a small firm called BlackRock. They see no AI bubble and says AI winners will drive market returns for a while. They say here the AI rally is supported by earnings and has more room to run. In our view, we don't see an AI bubble. A concentrated group of AI winners should drive market returns over a short-term tactical horizon of 6 to 12 months. The profitability of mega-cap tech companies stands in contrast to the unprofitable companies that fronted the dot-com bubble. Healthy corporate balance sheets and earnings momentum support our pro-risk view, which is exactly what I've been saying for a long time. Yes, a lot of people think, oh, it's the same bubble. It's the same thing as the 2000s. Look, everything goes up, it must be a bubble. Well, as we previously covered, previously you had a lot of money, but you had unprofitable businesses, plus early on tech, early on companies that had close to zero results. Some had results, but the valuation, the money that was flowing in, plus the money that was not flowing out, was nothing like today. Today, these types of companies, Nvidia, Microsoft, Apple, Tesla, Amazon, all those tech companies, even other companies, they're all generating a lot of revenues, a lot of profits, free cash flow as well. Yes, valuations might be stretched, but to say that this is apples to apples, I don't think so. I think it is flawed, especially with those companies. With small startups that aren't profitable, far away from being profitable, not even growing that fast, okay, I can agree. If you're paying 50 times sales for a company that is unprofitable today, not really growing 100% or triple digits year over year, then yes, you might call it a bubble. But so far, these big tech companies, they are delivering the goods each and every quarter. And I think we're going to see this continue because we're in the age where if you're already that big, you're just going to take more and more market share. The smaller player cannot compete. That's just my opinion. Now, of course, as now there is quite a lot of investment in the AI space, so a lot of companies that have the money, that have the means to fund all of those operations are going to spend it and are going to be in front. Which also means that the money that is going to companies like TSMC, Nvidia, ARM, and all of that, eventually it's going to slow down. Now, that eventually can take a year, 2, 3, 4, maybe even more. That even rhymes. Pretty cool. So that's that. Then you have other companies that might not have that much money to spend, and they're going to look at their return on investment and see, I spent so much money on these types of things, yet my returns aren't that great. Maybe it's time for us to spend a little bit less, take a breather, and see how we can go further. That might also happen. Now, with regards to Nvidia specifically, we also had insider selling. Ooh, horrible, right? I mean, when your stock is going up so much, of course, it's going to trigger that 10b5-1 trading plan. So Nvidia insiders reportedly sold shares worth over $700 million so far this year. Around 770,000 shares were disposed, lower than the 848,000 shares sold in the first half of 2023. Of course, the value of the share is significantly higher this year than last year. More than a third of the shares sold by executives and other insiders have come since the Q1 earnings in May. CEO Jensen Huang was the last to report a sale of over $31 million worth of shares in June. I mean, again, if you are, and this is part of the Rule 10b5-1 plan, I mean, when your stock is going up so much, of course, you're going to see quite a lot of those people there selling their shares. And of course, it might not just be them, right? It might also be retail or not retail institutional investors. They might also want to sell Nvidia shares eventually, maybe not now, maybe later this year, maybe next year, because right now it's just paper gains. At the end of the day, you will have to show results. Now, as a retail investor, that's the luxury that we have. We don't have to show results. We can never sell something and be happy with the paper gains. Or yes, sometimes if you want to buy a house, you want to buy a car, go to college, whatever, then yes, you will sell your shares, take the gains, pay taxes on that, obviously. That's a shame. But eventually, some people will start to sell because they are up 10x, 15x, 20x, or 200% if you bought more recently. That's also going to happen, and that's also something to take into consideration. Now, Nvidia specifically, this is basically what we get right now. Revenue in the last 12 months, $79.77 billion. Free cash flow, closer to $40 billion. Return on equity, 115.66% right now. Okay, truly incredible because of the explosion of, well, revenue, free cash flow, profits, you name it. Return on invested capital sits at 72.46%, also extremely high. If you look at gross profit, last 12 months, everything here is last 12 months other than the EPS, the 5-year growth rates. These are estimates right now. Gross profit, $60 billion. Net income, $42.6 billion. That's Nvidia, with the 5-year growth rate for EPS sitting at 31.7%. So despite this company already growing quite fast, the expectations are that it will continue to grow quite fast in the future. And this might be the reason why it gets, let's say, a premium, even though compared to its 5-year mean, it's not that higher with regards to forward PE. This is at 46.7 times compared to 41.9 times. EV to EBITDA is actually lower. 43.9 times was the mean, now 39.6 times. But yes, price to sales is now extremely high at 25.7, well, extremely high. We've seen higher, but it's 25.7 times compared to 16.5 times. Price to free cash flow is about the same, but if you look at price earnings to growth, so basically looking forward, 1.47. 1.47 is not expensive in my opinion, despite the stock being up close to 200% year to date, 200% year over year as well. 1.47 price earnings to growth, I mean, that's not that expensive for these type of companies. Now, if we compare Nvidia to Microsoft and Apple, the company that will follow Nvidia as the largest companies on the planet right now, Nvidia, then Microsoft and Apple, I've removed here price to sales because it's not that interesting looking at those companies, but the other things are still the same here. So as we know, forward PE for Nvidia, 46.7 times. Microsoft, 35.3 times. Apple, 31.3 times. So lower than Nvidia. Then EV to EBITDA, Apple, 24.3 times. Microsoft, 23.3 times. Whereas Nvidia, we know, higher, 39.6 times. If we look at price to free cash flow, that's in the last 12 months here, 47 times for Microsoft, 32.2 times for Apple, and 84.7 times for Nvidia. Now, of course, now you can already guess what I'm going to say. Yeah, forward PE, EV to EBITDA, Nvidia is more expensive. Last 12 months price to free cash flow, more expensive as well. But if we look at what's going on in the future or the expectations for that, price earnings to growth, as we've said, Nvidia 1.47, the cheapest out of the three. Microsoft 2.57, Apple 2.9. So now you're starting to understand why it gets a premium. It gets a premium because the market expects it to grow faster than the others. Now, let's leave the valuation metrics on the side. Let's look at the businesses. We've seen Nvidia before. I know it's a bit messy since there are lots of information on the screen here, so maybe just listen or pause the screen and you can follow as well. Basically, we have here Apple generating revenues $381 billion in the last 12 months. Microsoft, $236.58 billion. And then, of course, Nvidia, much less, just under $80 billion. If we look at free cash flow, same thing. Apple's free cash flow, $101.9 billion. Microsoft free cash flow, $70.58 billion. Nvidia, much less again, closer to $40 billion. We look at gross profit, net income. Apple gross profit, $173.9 billion. Apple net income, $100 billion. Microsoft, $165.3 billion in gross profit, $86.18 billion in net income. Nvidia, less on both. So yes, it is true. Apple, Microsoft generating more revenues, more free cash flow, more gross profit, more net income. All of that is true, more than Nvidia. But the reason why Nvidia is getting a higher multiple, which pushed it to the number one spot, is because the market is expecting Nvidia to continue to grow much faster than the other two. If you look at the other two, the expected growth rates, Microsoft, EPS-wise, Microsoft 13.72, Apple 10.63. Looking at the total revenue CAGR, 5 years, this is trailing 12 months. We looked at EPS, now I'm showing you here revenues. What happened? Well, what happened is Nvidia 49.37%, Microsoft 14.12%, and Apple just 8.10%. So I hope that by now it's pretty clear why Nvidia sits at the number one spot. I don't know if it's going to stay there forever. I don't know if it's going to stay there for a long, long time, because the moment those growth rates come down, the moment they show a little bit of weakness, of course, the stock will get punished. But so far, there's zero indication of that happening. Now, that said, maybe we're going to see an acceleration in growth for Apple or for Microsoft. Then they might get a higher premium than what they currently get. Could also happen. Now, just because Nvidia sits at the number one spot right now is not really a reason to sell. Might it be a reason to take profits? Yeah, maybe. But then again, I've been saying the same thing for a while. Taking profits is fine. Selling out of the position, only do so if the thesis has changed. If the business shows you some negative things, then okay, fine. But other than that, if you don't have to sell, then you shouldn't sell out of your position. But taking profits is always a good thing in my opinion. Of course, it can always go higher, but it can also correct. As we've seen in the past, well, if history can tell us something, is that yes, things go up, but when things go up, eventually they will go down no matter how good your business is. Because yes, sometimes the market will say, look, lots of paper gains, time for us to cash in, despite it being a good business. Maybe they're seeing better opportunities elsewhere. Could very much happen. So, I've talked for way too long. That's about it. That's the full review. Hopefully you liked it. Do share your thoughts down in the comment section below. Like, subscribe, notification bell on, do all of that. And I'll see you all in the next one. Bye-bye.